Hi and welcome to Coffee Break Accounting with me, Becky Brooksbank. If you haven't already done so, press pause now and head over to your kitchen to grab a cup of tea, coffee or drink of your choice, and then come back and join me for 10 to 15 minutes of jargon-free accounting support for your business. So hopefully you've all got your cup of tea, coffee and you're ready to go. So we're going to jump in. So as a recap, we are during series 3 looking at everything profit beyond the profit and loss account. Okay, so series 1 and 2 covered your profit and loss account and simple systems, and in series 3 we have been looking at things like cash accounting, the traditional method of accounting, which leads to having a balance sheet within your financial numbers, and understanding why this is really important that you fully get all these little terms and the terminology and what everything means within the balance sheet. So far we've separately looked at fixed assets, we've had a look at cash. Last week we looked at accounts receivable. Hopefully you went away and if you offer credit terms to your customers, did some calcs on what your debtor days are. So that's how long it's taking your customers to pay you. Now, why is that super important? Well, if you offer 14-day credit terms, for example, and your customers are paying you on average within 10 days, that's fantastic. You're getting your money in earlier, which means that your risk of bad debts is really low. However, if it's the opposite and you've calculated that your debtor days are say 20 days and you offer 14 days credit, that means they're taking on average nearly a week more to pay. Okay, and that's on average. So that means that you're not getting your cash in for your business as timely as you could, which might mean you need to tighten up on some of your systems and processes around bad debts. So that's why I left you with that takeaway task, so that you could have a look in your business. Also, I know it gets a bit mathsy and people like to work through it at their own pace. So I didn't want to do a whole example and take up the best part of 10 minutes within the coffee break accounting. But hopefully you sat there and you went through it and managed to come to an answer. So what are we looking at this week? This week we are looking at accounts payable. So these are, and we'll jump straight into the definition here. Accounts payable are money due to suppliers for goods or services that you've already received as a business, but you haven't yet paid for. Okay, so this is things you owe out. Okay, so accounts payable are obviously also known as the AP. So you might hear, particularly if you've ever spent any time in the accounts office, have you got the AP for me? Can you go and find the AP ledger? That's all they're meaning, is it's accounts payable, okay? Which means as a business, you have an invoice for something that you don't have to pay just yet, but you do have a legal obligation to pay the balance owed to the other company, okay? So you have to pay it at some point. It's just that they've been really kind to extend credit terms for you. So let's think about John Tapp, our resident case study plumber that we have on our system. So John Tapp may have bought the bathroom suite for Mrs. Brown's bathroom a week before he needed to do the job. That's fine. The job is irrelevant, but he might have not had to pay for that bathroom suite with the supplier he bought it from at that point in time. They might offer him terms to say, well, actually, do you know what? You can have a 30-day credit account. Pay us within 30 days of the purchase. So that would mean that John Tapp has had the benefit of the goods up front. He can probably actually get in and fit Mrs. Brown's kitchen, get the money from her, and then he'll have the money to pay out for the goods that he's already received for that job anyway. Okay, so it's kind of like a short-term IOU from another company. Okay, now when we say short term, it leads us on to this word current. So there are current, which are generally short term liabilities, and then there are longer term liabilities. Now, accounts payable falls under the current liabilities, i.e. it's due for payment within 1 year. Likelihood is it's due for payment a lot less than that, so it keeps it current. Okay. So remember, a liability is just an obligation or something you owe out. So a current liability is just an obligation that will need to be paid for within 1 year. Okay. So John Tapp may have a couple of suppliers that he has credit terms with, and the others may just be cash, so he has to pay for them at point of sale. And likelihood is most businesses will have a mixture of both. Okay, so you wouldn't necessarily have all your invoices which would fall under the AP, because some of them would be paid at the point that you actually buy the goods. So you've already paid them. Now, one of the critical things is that if you're, you can use your accounts payable balance to juggle your cash flow. So I just mentioned the sequence of events there where John has taken delivery of the bathroom suite. He then does the work. Mrs. Brown pays him, and then he's able to settle his account with the supplier. So that means his cash balance went up when Mrs. Brown paid him, and then it's gone down when he settled the supplier. Okay. Now just think, if it was the other way around, so say he had to pay the supplier first, his cash balance would go down, and then Mrs. Brown would pay him and it would top him back up again. So you can start to see how you can possibly juggle your AP balance for good cash management. However, if you're increasing your AP balance, what that's meaning is you're paying for less at the point of sale. So at the point of receiving goods, but you still have to pay for it. So it means that you need to make sure you have more cash in the bank later on to be able to settle those debts. So if you see an increase in your accounts payable, either you're managing it really, really well, and you keep topping up your cash reserves in order to make these payments, or on the bad side is you can't actually afford to pay these people, your bank balance is low and you're stretching your credit too far. Okay, so AP can be a really great tool to help you manage the cash movements, but if you start to overstretch yourself and you can't meet your obligations, then it becomes really bad. Now, I always recommend to my clients that they pay their supplier invoices when they are due, on their due date. Okay, so when we're saying good cash management, within the terms. So I've got loads of clients who go, oh, I've got an invoice and I'm just going to pay it. I'm just going to pay it. I'm just going to pay it. And they're super efficient and never actually take into account any of their credit terms because they pay within a couple of days. Now they could get into good habits and change that habit and say, well, actually, I'm just going to pay on the due date. So I'll keep the cash in my bank. I know I've got it, but I'm going to pay on the due date and make that conscious decision not to pay invoices straight away. Okay, all they're doing is deferring the payment slightly, but they're in control of the situation. So always bear in mind those due dates. One, if you go past it, you're creating yourself an issue for cash flow. But two, if you go too far, you could have your supply line cut off. So just think, those those suppliers who you owe too much money to and they're getting a bit worried you're not going to pay, will just turn around and say, nope, sorry, you can't have anything else anymore. That's going to disrupt and upset your business too. So we don't want to get into that negative situation. Okay. So what do the accounts payable look like in our balance sheet? Let's go and have a look. So our accounts payable falls, as I've said, under current liabilities. And I've just done a small snapshot here of a balance sheet example where it is. And you can see the accounts payable term fits in around right at the top of this one, actually. So this is showing that they've got £8,000 owed to suppliers of their business. Okay, and it sits with other short-term lendings. In this example, short-term loans, some taxes payable, some salaries and wages payable, some unearned revenue, which actually they haven't got any of anyway. Okay, so that's where the accounts payable would sit. Now, as we mentioned in the accounts receivable video we did last week, it's really important that you find a way to keep track of the invoices you haven't paid. Now, if you've got an Excel spreadsheet where you're tracking your books, this can be a little bit more problematic. So what I know many business owners do who are driving their books in Excel is keep a file of unpaid invoices, literally a paper file of unpaid invoices, so that every week they can go into it and they can see who they want to pay. they mark them off as paid, physically make it into their bank account, and then refile those as paid invoices. So they know that everything contained in that file is unpaid. Okay, so that's really important. Now, if you're using accounting software, and I've cribbed this accounts payable summary from Xero, and you can see it's from the demo company, so I'm not sharing anything client-based here with you. So you can see here, would be what an aged payable summary looks like. When it says aged, what it's meaning, it's taking the invoice and then aging it for when the due date was. So on this example here, you can see that actually there are a couple of balances which are falling 1 month overdue. Now, I would always say to my clients, use your aged payable summary to generate your pay run. So if you do a pay run once a fortnight, you can go in here and pick up who needs to pay. So if I was looking at it, anybody outside of current here, I would be adding on to my pay run this week to make the payments to them and clear those balances down. Now, it could be that the Smart Agency and Central Copiers here have an issue with the invoice. So might have to do a bit of digging to find out why they haven't been paid yet. But ultimately, that would be what I use to run my pay run and get those debts settled. So your aged payables becomes absolutely key to check and help you do that. Now, one other top tip that I always say to my clients as well is if you get a statement from your supplier which shows the list of invoices that are due for payment, always reconcile that. Now, what I mean by reconcile, and we'll do a whole session on reconciling later on in Coffee Break Accounting in a couple of weeks, is tick off your balance to their balance. So for example, if Smart Agency sent you a statement today saying this is the balance on your account and it's made up of this invoices, open your aged payables and check that your balance, 4,500, agrees to theirs. It could say 5,500, which means you're missing an invoice. So you will have to ask them for an invoice. It could be that their balance says 3,500 and you've made £1,000 payment towards this invoice that hasn't yet been reconciled in your bank. Okay, but you need to understand why the balances are different, because ultimately they should be the same at any one point in time. Okay, so little top tip there, if you get any supplier statements in, and good suppliers will send them once a month, then you need to be reconciling, i.e. checking them back to your accounting records to check that that's the balance you actually have in place as well. Okay, so that's our journey through the aged payables, accounts payables, explaining what it is, the obligation that you have, what it looks like in the balance sheet, and also how to keep track of them. So I'm going to leave you today with a takeaway task. Your takeaway task is to consider whether you're using credit terms with your suppliers correctly. So remember before we said if you've got cash, so if all your terms are cash, maybe there's somebody that might be able to offer you a credit terms. That means that you can then start to learn the art of cash management. Maybe you are one of their customers that just pays instantly, and they think you're great because you're paying instantly. But actually, within your business, for good cash management, you could pay on your due date. That's okay. Have a think about it. Or are you one of these customers that is always overstretching your credit, and is it flagging a cash management issue? Okay, so I'd love you to go away and have a think around your accounts payables and see the impact of that on your business. Okay, now obviously, as always, if you've got any feedback, any questions, feel free to ping me a message through the comments or anything else, not a problem at all. So I'm going to leave you now and head off. I think I'm just trying to think what next week is. It might be the session on reconciliations actually. So keep an eye out for that, and hopefully you will learn a huge amount more to help your business then. So thanks for joining me for some business support, and hopefully you've learned a lot to apply to your business, and I will see you again next week. Take care. Bye.